Alright, Joe, let's shoot this video, man. Things to do, places to be.
You in a hurry?
You know me.
We will do it, Jesse. Today is September 18th. I'm Joe Terril, president of Terril & Company, private wealth managers in St. Louis, Missouri, with approximately $530 million under discretionary management. Jesse, let's go in the other room and maybe work from there. And I want to ask Tricia Warner and Dave Carter to both come in and join us. And we'll start talking about what we see going on and what we think is going to happen.
Sounds good.
Into the other room.
Will do.
Jesse, quite a bit has happened since our last podcast of 4 or 5 weeks ago. I'm not sure exactly how long it's been. But the two biggest events that, and maybe three, that I would throw into that mix is concerns over Europe are beginning to calm down. Investors believe that perhaps the Europeans are capable of handling their financial difficulties and working their way out of their problems. The second scenario is the world economy seems to be slowing down a little bit more than what the average person expected. And then the third thing would be the biggest issue. The Federal Reserve Bank just recently announced they are going to do a third round of quantitative easing, plus they're going to continue their Operation Twist in a short and abbreviated manner. The Federal Reserve Bank has said we're going to pull out all stops to try and lower interest rates and try to create as much liquidity as we can with money in order to get the economy going again. We'll talk about in a minute the pros and cons of whether or not this is a good idea. But before we did that, because this is the first time that perhaps on our podcast people have met other people here on the staff, let me introduce real quick. This is Tricia Warner, and Tricia is a research assistant here at the company, does a great job for us on digging for data and finding out information. And then on the end is David Carter, a long veteran. I won't date him by telling how many years, but he's got many, many years in, and Dave's head of our research. And I thought it'd be nice for each of them to chat a little bit with their thoughts as well as mine on why, as a company, we're making some changes and we're doing things a little bit differently from certainly what our thinking was 6 months ago. The Federal Reserve Bank's monetary policy is predicated upon the fact, in a simplistic way of saying it, let's throw a ton of money at the economy and see if we can't drive interest rates lower and also provide enough liquidity that the banks will lend more money out into the economy and create economic activity, get unemployment down, etc. Very risky policy on the Fed's point, and no guarantee that this could happen. Actually, I would think, Tricia, since we started, the opposite has happened, hasn't it? Haven't interest rates actually gone up?
That is correct. Since last week's announcement, the 10-year government bond is up about 0.25%, and the 30-year is up about 0.3%.
In yield?
Yes.
So rates actually have gone higher, not lower, since they made the announcement.
A little bit higher, that's true.
And I'm assuming that's because of people's worries and concerns about inflation?
Absolutely, absolutely. People around the world aren't going to want to lend the U.S. money at in this inflationary time.
Yeah, if for our viewers, Jesse, if the Fed prints too much money and they're printing money, it can become inflationary. So that's interesting, and we'll get back to maybe in a minute some of the changes we're making, but I thought they were higher. Dave, on the stock side of the equation, stocks have responded in the opposite fashion, haven't they? Stocks actually had moved up in price for the most part. What are people thinking there?
Well, the equity participants like the easing in the fact that they believe it will stimulate the economy and push the GDP growth above the 1.82% sort of sluggish growth rate we're seeing right now.
So the equity performers are not as concerned about inflation as the fixed income people?
That is true.
Well, that would make sense that that's the case. So we talked about changes that we're making in portfolios, Jesse, and where we think people have to go. I think it's a consensus here at Terril and Company that investments that are fixed income orientated have gone up in price just about as much as what they possibly can. We've been a seller of fixed income investments. They're at all-time record high prices. Can't think of a better time to sell them and let someone else have them. What would you guess, Tricia, how many millions have we sold in the last week to 10 days, maybe since the Fed's announcement?
Maybe about 5 to 7 million, I think.
Yeah, well, we have more and more than that to go. And Dave,
Could be higher.
some of the bank preferred stocks, I know people are going to want to have a feel for why do we want to give them up now, but explain to people real quick, if you will, just maybe the fact about the calls and the fact they can be called early due to regulatory reasons and things like that.
The bank preferred stocks are basically a hybrid fixed income security, and a number of them have call features that, because of the new regulations, that the banks can take them away from us at prices that are at discounts to where they're trading in the market, and they're trading almost as money market securities right now.
So after having 3 years or more under our belt of owning some of these things that have provided us with very nice rates of return for the portfolio, it just seems to us like now's the time to let somebody else own them, go on down the road, and we'll find some other place to make our money. Equities, we'll have to see. Up until just recently, equities that were tied to the economy have underperformed. Equities that offered good income have outperformed. We may look more towards the equities that have underperformed, that are cheaper in price due to the fact that they're tied a little bit more to the world economy. Dave, you and I were talking recently about China and the slowdown in China, and I think our viewers would be interested in our take that some of the slowdown in China isn't necessarily due to weak demand. It's the Chinese government themselves wanting to change the direction of the Chinese economy to being more value-added economy. In other words, they don't want to be mass producers of commodities. They want to be a producer of more high-quality goods. They want to be in the computer software business besides just mass producing computer chips. So they throw in perhaps some of the slowdown in China that we're seeing is, if you will, self-imposed by the Chinese government as they're making somewhat of the switch. True?
Well, the Chinese government, unlike a market-driven economy, manages their economy on a five-year plans, and they just introduced a new 5-year plan which de-emphasizes the infrastructure spending, so it's only natural we're going to see less demand for materials, steel, concrete, copper, that sort of stuff that they use to build things with, and they're focusing it more on technology. They are increasing their investments in university academic research facilities and things like that. They're building up their
So said in a
knowledge.
simplistic sake, instead of being the manufacturer of the iPhone for Apple, now they want to be the person that designs and creates the technology that makes Apple phones work.
Well, yes.
So we'll see. We'll see if that works for the Chinese, but it's something to watch going forward, that perhaps the world economy is not slowing down as much as what some people expect, but we'll have to see if that's the case. And then maybe one other thing our viewers might be interested in that we get asked all the time, Tricia, is about the election. Everyone wants to know, will the market not go up or down dependent upon whether their candidate gets elected or not? Explain maybe real quick the fact that it's such a world economy with so many people around the world. 400 million people in developing countries around the world don't even know who's running for office in our country. True?
Oh, that's true.
And it's not to say that there aren't some differences philosophically between the candidates, etc. But we've made the comment that we don't look for a major move in the markets no matter which candidate gets elected in November.
That's true. Absolutely. Absolutely.
I'll even suggest it doesn't. The big thing that'll clear up is certainty. You know, we'll have certainty, and the markets like certainty.
True, true. Right now, there's a lot of uncertainty on people making capital expenditure commitments around the world. People waiting to see in the United States what's going to happen. They don't care what direction we go, but they're waiting to see what happens with our economy. And I think the only thing, though, that everybody really definitely is concerned about is they want us to do something about our budget deficit.
Oh, absolutely. It's out of control.
So we need to, no matter who gets elected, address that budget deficit. If we do, it'll be positive for our investments because the balance of the world is going to be much more willing to invest in the United States. So maybe just to sum it up, Jesse, I think that it's time to sell anything that is fixed income orientated, that has had these dramatic run-up in prices. We're raising a lot of cash, not sure where we're going to go with that cash yet. And equities that have had major run-ups, this might be an opportunity for us to get much more defensive there. Last time we did a podcast, we talked about the drought. We're yet to see how high food prices may go and what may happen to food prices. But I think the key thing for right now is watching this interest rate environment that we talked about. We're not convinced that the Fed's actions are not going to blow up in their face and make interest rates go higher rather than lower. Jesse, thank you for your great job as always, and we appreciate our viewers and your opinions, and certainly all of our clients around the United States. And if there are any questions, don't hesitate to call us or contact us. And once again, I'm Joe Terril, president of Terril and Company in St. Louis, Missouri. This is Tricia Warner, that's David Carter, and we will get you on the next go, Jesse.
Sounds good.